Hey, welcome back, everyone. It's John Pocoroba. This is time for a general market update. It's April 21st, 2023, and I'm recording this around 1:15 on Friday. So again, as a reminder, the presentation is by Rain King LLC, and I'm an amateur individual growth stock investor not affiliated with MarketSmith or IBD. So the agenda for this week is the market environment. We'll talk about some of the internals. Then a segment I call Should I Stay or Should I Go? And an overall summary. So let's get right into this. Let's get into the market environment. What's happened in the past week? So this is the NASDAQ composite on a weekly basis. Fairly simple to interpret. You got a downtrend line that we broke. The index came back, retested the line. We're still above the 10-week and the 40-week moving average, which is really constructive. It's an uptrend that's starting to try and to emerge. And the relative strength line right now is showing that the NASDAQ is outperforming the S&P 500. So looking at the S&P, I've shown this chart the past couple of weeks. We're still in the same situation, kind of locked between 4,100 to 4,200 as resistance. We moved into the box this past week, but we've been kind of pulled back down at the lower end of the box. Again, there is a series of higher lows. It's choppy, but it's still a constructive pattern, even though it's not a fast-moving market. Now, looking at individually at the NASDAQ on a daily basis, the basic premise that I'm using is the depth of the sell-offs. First sell-off was deep, second one less deep, and I continue to hold to the premise that even if we declined all the way back to the 50-day, I think that would still be constructive. We did have three powerful follow-through type days over the last 3 weeks to a month. We tried to get into some of the resistance, but we got pushed back again. So we're not quite there yet, but it takes time for these things to build into a sustainable trend. I pulled this piece of Carson research. This is actually showing that when the S&P has greater than a 7% gain in the first quarter, of which we had one this year, the full year returns are actually very, very good. There's never been a down full year return after the first quarter has been positive. So what will we get this year? We don't know. Anything can happen, but it does say the odds are in our favor that we're going to be in the green, but you can see that the average is 23%. So we'll see how it goes. The other thing that we have on our side is, remember, the January trifecta. And if you're not familiar with the trifecta, go to my January 27th general market update, and it goes over that in a little more detail. But basically, 28 of the last 31 trifectas, or 90%, have resulted in a positive year for the S&P with an average gain of 17%. So both of these are telling us that the odds favor the S&P will be higher by the end of the year. So let's get into market internals a little bit. This is the National Association Active Investment Managers Exposure Index, which is a 2-week moving average of their exposures. And I've taken the levels and overlaid the colors. Generally, when you have over 85% exposure or more for these active managers, we're probably near a top. You'll notice that we had late 2021, we had some extreme levels, and we actually were very close to the top, which happened in December in the S&P. When you're in the 30 to 60 range of exposures for these active managers, that's generally associated with corrections in the market. And when we get down to 10 to 20% are real bearish exposure levels by active managers, they usually coincide with market bottoms. And you'll notice that the most extreme level we had was in October. Beginning of October, we were way down around 15%. And that was just about right where the bottom has been put in that's holding so far. Now, the trend is, you can see we have higher lows. Managers are putting more money to work. The question is, the banking crisis that we had in March and February certainly has possibly changed some of the positioning that active managers are using. The question is, they are putting on more exposure up to 78%. The question is, are they positioning themselves for bearish outcomes or bullish outcomes? That we don't know. So let's look at the New York Stock Exchange new highs, new lows. This is a net new high, new low. And again, not much change from last week. This is the New York. It's just showing that the rally is really still pretty weak. These numbers of new highs is nothing to write home about. You can see that these level of new highs were associated in a similar fashion in the November rally, which was a very weak rally that didn't really go anywhere. Now on the NASDAQ, it's more of a more bleak situation. We have not had new highs for almost 8 weeks other than this one bar here. And we need this. We are not going to get a real rally, a playable rally, until we start to see net new highs. You just have to have that. You have to have some breadth of the market. It can't be led by the NASDAQ 100's top 10, 15 names. They're just not going to go very far without broader participation. So this, we really just keep our eye on it. Don't like how we keep seeing spikes, even though they're drying up a little bit, which is constructive. It just needs to change. We got to get some progress here. This is the New York Advanced Decline line. This is showing the resistance level in the Advanced Decline line from last August. We hit a peak, and then back in February, we hit a peak. We're improving, but we're going to have to get the breadth to push through this to really show us that we've got a rally with some legs. This corresponds with the S&P 4100 to 4200, which we talked about. It's just there's resistance in price and in breadth. S&P, these are the New York Stock Exchange names, the percentage that are above the 200-day moving average. I look at this because we're just trying to understand some breadth and which stocks are in uptrends. Now, when we on a bullish situation, we want to see the percentage of stocks over the 200-day to be above 70. We got a little bit of that at the beginning of the year, which looked good, but then it deteriorated very, very rapidly. Typically, if you're below 50, it means you're in some sort of correction in the market, and we certainly were during February and March. You can see our current level is right around 59. So we're in this no man's land. We're not in a corrective territory. We've recovered a little bit, but we certainly are not in a bullish set right now. So we're just in this is a kind of a no man's land. I have to wait and see how this goes. I pulled up the IWO ETF. This is a small cap growth index, and just wanted to point out that there's just been this kind of coiling. The index has come down, and you kind of have this downtrend line. We kind of bottomed out later in March, and it's trying to make higher highs. So you're getting this kind of, call it a symmetrical triangle. Certainly some coiling action, and you can see that the moving averages are all starting to bunch together. The 50-day in red has acted as resistance so far with the downtrend line. So, we need to see this resolve itself. Hopefully it's going to be higher, but it also could resolve itself lower. So we'll have to keep our eye on it. It is a gauge of some of the small caps. Now, should I stay or should I go? Last week, we talked about building your watch list and how that was important to use weekly charts. And we talked about institutional demand, and there were stocks that were already showing themselves to show institutional demand, and we covered a couple of those in some charts. And then we said, let's keep our eye on the stocks that are still building demand. They're building bases. They're showing that they're showing accumulation in their bases. Now, I want to go a little further into this week. Now, here is just a quick little partial chart of the NASDAQ. And over the past, I think, 10 to 15 trading days, we've been going sideways at this resistance level. But you'll notice that if you look closely at these candles, there's a whole bunch of little gaps up and gaps down. This has been a very choppy period, even though it shows kind of benign on the major chart. But gaps up and gap down are really tough to deal with if you're trying to trade. You get a position, you get knocked out, or you get knocked out and wish you were back in. So this is choppy. There's no trend. So, what are we seeing? What is all of this about in the activity and some of the price action that we're seeing? And what is it saying for institutional activity? Is it a situation where some of these institutions are really preparing for a hard landing scenario if the Fed keeps raising rates and overdoes it? If it gets overcooked, maybe the economy goes into the tank. And we have seen this, there are growth names that are being bid up, that are being accumulated by institutions. So we don't know exactly what the institutions are doing, but we definitely have some of the footprints and clues to try and interpret that. So I wanted to come back to this seesaw that I've used before. We are seeing currently dips in the market are being accumulated by some institutions. And we are also seeing consistently when we hit little new highs in individual stocks, there's distribution going on. There's still not a lot of healthy follow through that we're seeing in some names. They go to new highs, they get smashed back down. So we're seeing a bit of both. And you'd say, maybe the environment is we're just balanced. There's this institutional balance with different perspectives. So I wanted to try and play this out in a diagram to try and explain the concept, to try and understand what may be happening in the market. And these are just my thoughts. So when you're in a new bull market, and I'm using an example of Fund A, these are both two growth funds. So Fund A is buying in the beginning of a new market. They're taking new positions. And Fund B, another growth fund, is also buying. And you get this alignment where there's heavy buying in the market and it starts to push stocks up. So at that point, the seesaw is unbalanced. We have many, many more buyers, funds that are buying stocks versus ones that are selling. And it allows prices to rise in a bull market. And so we'll get a nice uptrend and we'll start to see gains. And then let's assume that Fund A starts to distribute their positions. They start to sell some of their position on the way up because they have a large position they want to start to liquidate. Now, Fund B, their analysis says that the stock could go even higher. So they're continuing to buy. Let's say Fund A is still looking now to exit their position. They start to sell more of their position and they're looking to get out. The price volatility is maybe getting a little bit extreme, long in the tooth, maybe in the trend. So Fund A, when we get to market tops, let's say fund number A or letter A has sold. They sell the last third of their position and they're out of the market in terms of growth stocks. They've exited their position. Now, Fund B, their research department says, we still believe the market and the stock could go higher. So they bought more over here higher. And actually the first dip down, they said, we're going to buy some more. We believe the stock can go higher. And they buy more. Now, when the Fed started raising interest rates and the whole environment changed, a fund can get caught in a big downdraft. And as we all know, 2022 was a consistent bear market. It came down and it's kind of bottomed out in the October timeframe. So we have Fund B that's basically still holding shares in a growth company, where Fund A is completely exited their growth positions. So what happens, the market starts to try and make some progress and rally, and we get two things happening. Every time we make a new high, if a stock is making a new high, this fund now is saying, look, we made a big mistake up here. We shouldn't have bought more. We need to get out of this position. We don't believe in this growth stock anymore. So every little indication they see some strength, they're going to sell. Stock tries to base and go sideways. It breaks out into new highs. And Fund B says, dump some more shares. So it snaps the stock back. And they're consistently just trying to get out of that position that was a mistake. Now, if you're Fund A that exited perfectly near the top, they're in a different situation. They're saying, we really are looking forward, 1 to 3 years, and we like the prospects of the particular growth company we're looking at, and we want to accumulate a new position. So they are the ones that in the bases are creating the buying. And as the stock gets hit, comes back down, they're buying up the dips. So you have this dynamic where there's some funds that are buying the dips to accumulate their position, and we have Fund B that are looking to get out of a position that has become a major loser. So again, it creates some of this balance where it's very difficult to see a trend emerge because there's competing interests among some of the funds. So there's a lot of, hopefully this diagram is helpful to understand a little bit about what could be happening with some of the growth stocks, that they're not just going on a big tear, because there isn't that kind of alignment you get in a brand new bull market where everybody is really buying and accumulating positions. That can change in time as time shifts. Federal policy may shift. We just have to give it time. So ultimately, it's where we are today. We have a choppy, trendless market. The positive is it is grinding higher with higher lows. We have hit some resistance, so we have to be patient to see if this plays out with another leg up, or we're going to come back down and have a little bit more of a correction. So the summary this week is there really is no significant changes. It's more of the same. We're in a sideways consolidation, and the market really needs a catalyst. It needs something to help it break higher. Maybe if we get lower inflation reports along the way, that could be a positive. Or, as I mentioned, we may have to come back down to the 50-day with a little bit more correcting to do and bide some time. The Fed is likely to hike rates one more time here in May. I think there's an 85% chance that they're going to do another 25 basis points. The real question, though, is will they need to do more based on the data? The market seems to think that at the end of the year, they'll be cutting. But the Fed has not really tipped its hand about that at all. If anything, they have just said consistently they want to see data that shows that the increases to date are really having the desired effect. So we're in the chop, we're in the consolidation that's going on. I think there's a couple things to note. One, try to sit, if you have some positions and you have a good average cost and you have a little bit of cushion, you could try to sit this out and hold your position. And hopefully we break higher. Now, I will note that it's not a place to be adding to your positions, particularly on strength, because as we mentioned, there are definitely still funds, growth funds, that are distributing stock on signs of strength. So it's dangerous to buy on strength right now. And if you're in complete cash, that's just fine too. You can just sit tight until we see the breadth really improve, and we want to see more consistent price action that shows bullish activity. We're watching the breadth, the new highs. They need to improve. So we have our indicators. We'll know when things are changing. We just have to be patient and monitor things as they're occurring. So in the end, as Led Zeppelin said, the song remains the same. There's not a lot of change here from this week. And the quote of the week is from Jesse Livermore. Money cannot be made trading every day or every week during the year. So the point is, patience takes patience. There's a time to do nothing, and there's a time to really take action. So take that to heart with your positions and where you're sitting right now. Things will improve, hopefully, in the future here, but right now we have to take it day by day. That's the general market update for April 21st. Here's where you can reach me on Twitter, YouTube, and my email. And I look forward to seeing you all at the next general market update.